Thank you, Brian and Melissa. Welcome to the Closing Bell, everybody. I'm Kelly Evans to close out this tough week for stocks here at the New York Stock Exchange.
I'm Bill Griffith. What can you say about this week? I mean, we've itemized it every day. One big up day on Monday, a big down day on Tuesday, quiet on Wednesday. Big up day yesterday, and today a big down. I mean, this is volatility personified right now.
It is. The VIX right now up to about 16.5. I think we're still off about 1% on the major indexes for the week. Of course, anything could happen in the final hour here. But running through the carnage, the Dow's off 220 points this hour. The S&P's off 20.6, and the Nasdaq, that's the one that's off 39, as you can see right there. Also keeping an eye on the small caps, flipping through, looking for the names as they get more attention on the valuation here, and more people, Bill, want to play these as a way to protect themselves against some of these external currency moves. Watch this index for signs of overvaluation or a pullback.
What's calling the shots today? Oil. Oil has been continuing to move lower on more evidence of ever higher inventories in this country. We're still just pumping like mad and filling up coffers around the country. So the price of WTI crude is now at $45, and Brent North Sea closed below $55 a little while ago. And oh, by the way, the dollar continues to move higher as well. So we're now at $1.05, I guess, at this point.
Look at that round number on the dollar index, 100. It was not that long ago this thing was trading in the high 70s. A huge move. Again, a lot of that is against the euro, but it's not just the euro.
Right.
It's other foreign currencies as well.
And that contributed to the producer price index declining here. Hey, let's talk about it all on our Closing Bell exchange. What do you say? Kathy Jones from Charles Schwab is back with us. So Steve Parker from J.P. Morgan Private Bank. Ken Mahoney from Mahoney Asset Management. Joe Heater from Cirrus Wealth Management is with us today. And our Rick Santelli standing by in Chicago. Ken Mahoney, you say this market's acting like a spoiled child. What do you mean?
Well, it's been getting everything it wants. I mean, for the last couple of years, we've had Fed fund rates at 0 to 0.25%. And now we're talking about raising rates, and now we have this tantrum, much like the taper tantrum we had a year ago. But we should all embrace higher rates. That means the economy can withstand higher rates. Look, we need some ammunition for the Fed here. We can't hover around 0.25%. We need to normalize rates, maybe 2.5%. Give them some ammunition, to sustain this economy. So in case we falter, we have something to work with. So, we're still very constructive on the market because we think the Fed, eventually we're going to see this be decoupled. That when Fed rates go up, it's a sign that the economy is getting stronger and the sustainability of it.
All right. Well, speaking of that, Rick Santelli, the big date next Wednesday, March 18th, that's the Fed's next meeting. Everybody here just kind of waiting or putting in their guesses as to whether that patient language comes out. How do you think the market trades, Rick, if that language does come out?
Pretty much like it's trading now, which to me is one of the major issues that I think the Fed should pay most attention to. We are kind of going through the withdrawal anxiety that's going to be necessary. Someday it's got to happen, and I think we're, at least partially through it. I think it's a good time to keep normalizing rates, and I want to underscore this, especially now, because what's going on in the Eurozone opens a window for the Fed to have normalization, whether it's throwing some of the reserves in a marketplace that really needs some high-quality collateral like treasuries, or even if it raises rates to normalize a bit. I think what's going on with Europe makes potentially a better climate to do both of those things. Just remember, the ECB says, we're doing QE, we have plenty of boons, and I did a piece today going, dude, where's my boons? If you look at the fact that they've had a surplus in 2013, a big surplus in 14, we're seeing budget surpluses in Germany till 2017. Why are they going to issue any paper? When we had our full surpluses in the Clinton era, we stopped issuing 30-year bonds. So there's a lot of abnormalities out there. I think it's the perfect time for the Fed to do what makes the market nervous, and I agree with the guest. It's a market. If it goes down, so be it. That's the risk of being an investor.
Yeah. Kathy Jones, what do you think the Fed's going to do? I mean, when you consider the backdrop right now, the producer price index lower, and continuing to move lower as the dollar moves higher here. Do you think the Fed is likely to remove patient from its language and start setting us up for a rate increase when inflation just is not on the horizon right now, at least statistically?
Well, they seem to, at least by their comments, seem to be moving in that direction, removing the patient language. But I have to wonder if this rise in the dollar and the drop in the inflation numbers doesn't give them some pause along the way. Because frankly, we've got import prices falling by 8.5% on a year-over-year basis.
Wow.
And even, it's not all oil. I mean, it's a lot of prices across the board. You have the dollar rallying very strongly, which is only going to reinforce that decline in import prices. And wages are growing at about a 2% pace. So even though the unemployment rate is down to where the Fed thinks it should be to start igniting higher wages, it's not happening. And as you mentioned earlier, consumers still haven't decided to spend that windfall from energy. They're saving it. So I don't know what the hurry is on the part of the Fed.
Steve, going back to a point Rick made, it's one that has a lot of people scratching their heads because I guess it's a little bit unusual. They're saying, look, there's not enough bonds out there, maybe even enough stocks or other kinds of assets for the European Central Bank or all these central banks to buy. What are you seeing in terms of how that scarcity is pushing up prices and what should be done about it, if anything?
Well, I mean, without question, you're seeing global assets around the world being reflated. One of the things that I think is really important, and Rick touched on this, if the Fed raises rates on the short end, and they're going to do it only when they feel like the economy is in a position of strength, all of that easy monetary policy around the world is creating huge demand for longer dated assets, which means that we're not necessarily going to see a major impact, something that would cause a slowdown in the corporate sector because of all of that central bank buying.
Yeah.
Meanwhile, Joe, the volatility continues in the stock market, and you think we're in this for a while. I mean, what are the cross currents? Are you likely to want to buy the weakness or sell the strength as this volatility continues?
Well, that's a tough one this week because you'd have to be reacting on an hour-to-hour basis, day-to-day. But, you know, anytime there's a basic change, and I think we're basically at a crossroads, we're focused on Fed policy, the same kind of volatility that we saw when they started talking about tapering, and you know, we were going to see the end of the bull market. The economy was going to slip right back. None of that happened. I think it is a good time to be looking at raising rates at in a very modest fashion and setting the stage for long term to normalize interest rates.
And a lot of people have been bargain hunting in the energy space. But Rick, don't you think, you're the pro here, I mean, don't you think oil's trading in a way that suggests it could easily move another $10 to the downside here?
So what? So it moves $10 to the downside. You know, I really don't think it's the end of the world, and I don't think import prices being down is the end of the world. What's wrong with the middle class in America getting a blue light special on buying some of these products that are being exported from other countries? I understand the issues with multinationals.
The energy space. But, yeah, that's my point. For people who are investors, Rick, and looking at this space, they need to be cognizant that oil here doesn't look like it's going to perform well. Investors have been accumulating in these sectors for 3.5 years, where Santa Claus comes down the chimney every 6 weeks in the form of Fed meetings. Maybe they should be a little wary. And in terms of what you're talking about with energy, all I know is I see a lot of private placement deals moving this paper. I see shadow banking moving a lot of the paper. I still don't think it's a problem. Markets go up, markets go down. That's life.
Yeah. You know, we shouldn't be surprised also by oil here. I mean, any asset class or sector that gets beat up like that comes straight down, and then it bounces up a little bit, right? And that's either a counter trend rally or a short cover rally. And then guess what? It goes back and retests, and that's kind of where we are right now. So if you look at the technicals, whether it's a sector, an asset class, or even oil, this is how it plays out. Now the question is whether it stabilizes here after retest. But this shouldn't be a surprise to anybody because this is how markets work.
Are you going to buy energy here then, Ken? Is that what you're saying?
You know, I'm going to wait for a little bit more here. I would like to see, throw out the, baby with the bathwater, so to speak. You know, when really people like hemorrhage, we're not quite there yet.
Wow, that's a question as well we're going to just quickly ask you about, Joe. You mentioned here looking into stocks, looking around for value. What do you think about energy? We're going to talk about Exxon specifically in just a moment. Or where in general what do you like here?
Well, I mean, I like energy, but I think it's a little bit wait and see yet. I agree that I think there's room to fall, and I look at it as a net positive as long as you're not holding or an employee of an energy company. It's great for the American consumer. It's great for putting money in the pocket of all classes, not just the middle class, but everybody.
Kathy Jones, clearly the dollar-euro relationship is narrowing to the point where they're expecting parity at some point in the near future. What's the view at Schwab? How much lower do we go? And what does that do to interest rates in this country, do you think?
Well, yeah, we think it could be a multi-year bull market for the dollar, and particularly against the euro. I'm not sure it will stop at parity. I could certainly make the case that it can go well below that, maybe into the low 90s. And the reason is it's really what Europe has to get going, right, is a cheap currency. It's helping the exporting countries like Germany tremendously. Other than that, there's still bank lending is still pretty constrained. There's really nothing going on there. So it's the impetus that Europe is trying to use to get the economy going. So, and the U.S. doesn't need really a cheap currency to get the economy going. It's going along okay. So I think dollar could have a couple more years to the upside here.
So we don't have to book a flight to Europe this summer necessarily and be in a hurry. We've got a couple summers to Europe's
I was just going to ask, Kathy, a research trip maybe?
Yeah, that's right. I'll have to investigate some things in the south of France this summer.
Yeah.
All right, folks, thank you very much.
Thanks everybody.
Appreciate your comments on the markets on what has been an incredible week again on Wall Street. Thanks, everybody.